Hi, everyone. As you are filtering in here, I'll do a quick introduction for myself, for sales tax and more, and also go over a few housekeeping things. So first and foremost, my name is Ellie. I work with sales tax and more. We're really excited to have you here, especially if you're here for CPE credit, which is fantastic. We do need you to do a few things in order to receive that CPE credit. The first thing we'll need you to do is to answer all of our poll questions as we are going through here. So as those pop up on your screens, go ahead and fill them out. The other thing we'll need you to do for that CPE credit is fill out the survey at the end of the webinar. There are a couple ways you'll be able to do that. It will pop up on your screen. However, if pop-ups are blocked or you don't have time, don't worry. In 24 hours, that survey will be emailed to you and you can fill it out then. No need to fill it out twice. A couple other important things to take note of as we go along here. If you have questions as we're going through, please ask us. Use the Q&A button in the middle of the screen. We will answer your questions at the end of this webinar or follow up with you via email. Either way, we will answer your questions. We will also be sending out the slides for this webinar. You can look for those in the chat box once we get the ball rolling a little bit here. The chat box is also where you will find the handouts from today. We'll be linking those for you as well. So let's do a quick introduction for Sales Tax and More, Mike. Sales Tax and More is a full service consulting and solutions firm. We have a great team of experienced tax professionals who are very dedicated to fulfilling your state tax or related needs. So we do a lot of returns, registrations, consultations, research, and like our name states, more. If you have questions, please reach out and ask us. We'd love to answer those questions for you. And a quick introduction for Mike as well. So Mike is the founder of Sales Tax and More, and his state tax knowledge is very well rounded. He's one of the United States leading authorities when it comes to e-commerce, Nexus, service providers, and drop shipping. Over the years, he's assisted thousands of sellers, both foreign and domestic, with their state tax related needs. So Mike, if you want to take it from here, we can go ahead and get started. And yeah, go ahead.
Thank you, Ellie. Great job, especially considering you were injured this weekend. Ellie's got a banged up knee pretty badly. She was a victim of someone crashing into her on the ski slopes. So thank you, Ellie, for powering on through this.
I have quite the setup over here, Mike.
I know, you were telling me. So thank you. Anyway, we got a lot to cover today. We're going to cover the first of the four pillars of a successful sales tax strategy. This is part one. Those pillars are Nexus, taxability, rates, use tax, and then we're going to open it up to questions. I tend to speak a lot with my hands and move all over the place. I get pretty excited about talking about this, so I find that very distracting, and I don't want to subject you to it. So I'm going to turn the camera off when we get to our first poll question and then turn the camera back on when we get to the questions at the end. Right now, one of the things we always start out with is the first time, the worst time to find out you have any problems is when a state's knocking at your door, when they're sending out a Nexus questionnaire, or your client's door, or they're sending your client a questionnaire. The reason why is that your options are very, very limited at that point. If you're being proactive, you have lots of options. Once the state's there, once the state's trying to contact you, a lot of those options go away. So the worst time to find out you're having problems is when the state's knocking at the door. Ellie, let's do this first poll question.
Absolutely. That should be up on everyone's screen right now. A quick reminder that if you are here for CPE credit, you do have to answer these poll questions. We just want to get a feel for who is in the crowd right now. So Mike, a lot of people know the basics in this crowd today. No experts so far, but kind of an even spread between the three other levels. So we'll leave this open 5 more seconds here and close it out and move on.
Okay, Ellie, and we've got, a couple of different webinars out there that are dedicated solely to Nexus. So we're going to touch on Nexus today, but we're not going to go into too much detail. We're going to give you a couple of tools that will help you or help your clients. But we invite you to come to any of our other webinars where we're going to do a deep dive or a deeper dive into Nexus. For today, let's start out with a definition. And Nexus is just a fancy word for link or connection with the state. And it's the link or connection that must be present before a state can require you to do anything. Like collect its taxes, whether it be a sales tax or a use tax, or pay its taxes like an income tax, a franchise tax, or a consumer's use tax. So because this link must be present, we say it all starts with Nexus. And if you don't have Nexus, if you have no Nexus, if you have no links or connections with a state, then you've got no problems and no responsibility, because the state cannot require you to do anything. So that's why Nexus is our #1 pillar. Knowing your Nexus footprint or knowing your client's Nexus footprint is paramount, because it'll tell you what you need to do going forward. Now, historically, we had to have a physical presence when it came to at least sales tax Nexus, but that changed with the Wayfair case back in June of 2018. And now we have an economic nexus. And what that means is that this link or connection we talk about can be based on sales or transactions. You no longer have to have a physical component to require sales tax collection or requirement or returns. So South Dakota, they said $100,000 or 200 transactions was fair. A lot of states just jumped on the bandwagon and they, followed behind South Dakota. Sometimes non-taxable sales are included. Sometimes they're excluded. States, may include all exempt sales except for sales for resale. Lots of different ways that these thresholds are actually calculated. As of now, all states but Florida and Missouri have thresholds. Florida and Missouri have bills pending. We think that, sometime this year, those states will have their economic thresholds out. As of now, Missouri looks like they're going to be effective sometime around October 1st. Florida, the governor's threatening a veto. We think that there are enough votes to override that veto, but we'll wait and see what happens in Florida. In Kansas, there's a bill pending now to make this all legitimate. It looks like they're going to go with $100,000, no transactions. But the what happened last year is the governor vetoed this legislation twice because it was tied to some tax cuts. He said we need all the taxes that we can get our hands on. So the Department of Revenue in Kansas came out and they said, well, we don't need an economic presence. We don't have the ability to, talk about thresholds. So we're just going to go as if one sale actually creates Nexus. And a lot of our competitors are out there still saying, hey, if you have one transaction in Kansas, then you need to get registered. But that's not true. The Attorney General in Kansas came out about 10 days after the Department of Revenue made that statement and said, guys, no, you can't do this. You got to at least follow South Dakota with their $100,000 or 200 transactions. At this point, if you have exposure in the state of Kansas and you're over $100,000, 200 transactions, and when I exposure, I mean material exposure, then I think it makes sense to go ahead and get registered. Louisiana has thresholds, but they put them on hold. It's $100,000 or 200 transactions. They're now saying that those are going into effect on July 1st, but they have also notice and reporting requirements. So that are catching a lot of sellers. That's $50,000 for the notice and reporting requirements that are in effect right now. Most important thing to remember when we're talking about economic nexus is that it does not override any other types of nexus. I have people who call me up all of the time and, they say, Mike, can I get deregistered? I say, well, why do you want to get deregistered for? Well, we're under the $500,000 threshold in the state of Texas. And I say, okay, well, due to my memory, last time we talked, you had inventory in Texas, or you had salespeople in Texas, or whatever the case may be. They said, we still do, but we're under the threshold. No, it doesn't work that way. The economic nexus does not override any other type of nexus. It's actually the other way around. Physical presence. If you have some type of nexus due to physical presence, that's going to override or trump the economic nexus. So this doesn't protect anyone at all. It just gives the states one more way to try to get you or your clients to collect or pay their taxes. Ellie's going to be handing this out. This is a chart. It's our economic nexus chart. We update it quite frequently because even states that have had an economic nexus out for a while are constantly tweaking how they calculate things and what's included, what's excluded. So this is a great tool, whether you're using it for yourself or using it for your clients, where you can figure out, if you have an economic nexus or if they have an economic nexus. It'll tell you what the monetary threshold is. It'll tell you what the transaction threshold, if any. There's actually a trend away from that. It'll tell you what the calculation methodology is. Is it based on the previous year and the current calendar year? Is it based on the prior 12 months? Those are the three ways that states do look at this, and you'll see that, there's a column there for that. And then what's included in the threshold calculation and what's excluded from it. So, and that's changing all of the time. So great tool. It's free. It's on our website. You can go out there. It's under resources, charts and matrices. So feel free to download it whenever you want. And Ellie should have put it out there for you now. Now, there are lots of types of physical presence nexus, and we're not going to go into all of them. As I mentioned, we have a whole webinar devoted to physical presence nexus, but I do want to talk about third-party nexus. And this is because of all the different types of physical presence out there, this is the one that trips up companies the most, trips up, companies' advisors the most, because, common sense, how can a third party, someone who has no relation to us whatsoever, maybe we hire a company to do something for us, how can they create nexus for us? Well, the Supreme Court has said twice that the activities of third parties can actually create nexus. Once back in 1960, I believe it was, and that was the Scripto case. And then again, in Tyler Pipe, which was 1987. And the language that came out of Tyler Pipe, very, very important. They said that, it doesn't matter what you call someone, doesn't matter what you pay them, doesn't matter if they represent you exclusively or if they represent multiple people, doesn't matter if they do it on a full-time or part-time basis. Here's what's important. Are they helping you to establish and maintain a marketplace? And that language, helping to establish or maintain a marketplace, is so important because a lot of the states took that language and incorporated directly into their statutes, their rules, their regulations, their guidelines. They use it to, come up with new theories on how to tax, like New York and their click-through nexus used Tyler Pipe as the basis for that. Although Scripto and Tyler Pipe were both about sales, really this language is umbrella language now, and everything up on the screen there falls under this umbrella of helping to establish or maintain a marketplace. And by the way, there's a lot more than what I have on the screen. I'm not going to go through all of this individually, but here's what we tell our clients. If you're working with an independent contractor or a subcontractor, so many times people tell me, no, we don't work with independent contractors. We use all subcontractors. This doesn't apply. Yes, it applies. Independent contractors, subcontractors, if you hire a company, don't even call them independent contractors or subcontractors. If they're helping you to establish or maintain a marketplace that could be nexus creating. So here's the cheat that we tell our clients. If they're client facing, if they're interacting with the clients or the public, or they're going to a state to perform services, then that is generally or can be nexus creating. if they are, let's say you hire someone to do some software programming for you, not interacting with the public, they're doing back office stuff, generally not going to be Nexus creating. Bookkeeping, another example. So if they're helping to establish the market, going to generally be Nexus creating. And this is a huge, huge issue for many companies out there. They just don't realize, I mean, common sense, you know, how can a third party actually create a responsibility for me? But unfortunately, the Supreme Court believes they can. Here's two charts or lists, and not charts, that are up on the website. The first one is 10 common Nexus creating activities. Ellie is going to go ahead and post this for you. And when we say common Nexus creating activities, most states view these activities as Nexus creating. I mean, there may be one or two states that deviate on some of these, but ownership of real property, that's going to be something that pretty much every state is going to think that that's going to be a Nexus creating activity. Leasing of personal property into a state, another one that trips up companies. Independent sales reps, manufacturers reps, subcontractors. So a lot of great activities on here that most states, that's why we call it common, are going to say these are Nexus creating activities. The next list, and this is 12 state specific Nexus creating activities. So these vary widely from state to state. So trade show attendance, you know, this is a good example. There's really a number of different ways states look at this. Some states say that if you even show up at a trade show as a consumer, that's going to create Nexus. Now, I think that's going to be hard for a state to hold. I've never heard of a state's, you know, actually going after anyone as a consumer at a trade show, but they say that they can. By far, the biggest group of states are those states that say if you're an exhibitor at a trade show, then we believe that to be Nexus creating. But some states actually draw a subtle distinction between exhibiting and soliciting. I think that exhibiting is pretty much soliciting most of the time, but some states draw a distinction. They say you can exhibit as much as you want, but once you start soliciting, then that's going to be Nexus creating. Then you have the next group of states that says, hey, you can solicit as much as you want, but you can't accept orders. Once you start accepting orders, then that becomes Nexus creating. And then you have a state like Nevada. They want everyone to go to Las Vegas, and they say, hey, you can, you know, accept as many orders as you want, but if you're delivering and taking payment at the same time, you know, at a trade show, you can even do that, so long as you don't do it more than once a year. If you do that twice a year, then that does create Nexus. If you're only doing it once a year, then you can collect the tax. Yes, Nevada wants you to collect the tax, but you can give it to the show promoter at the end of the show. Or if that doesn't happen, then when you get home, you just mail it into the state and you don't have Nexus, no more responsibility. Doing it twice, that does create Nexus. So trade shows also. People always talk about de minimis activities. Well, most states don't spell out what de minimis activities are. But when it comes to trade shows, some states do. Some states say that if you're here less than 2 weeks total during the year and you're less than 100,000 in sales result from it, then that is not going to be Nexus creating. Other states say if you're here, you know, less than 3 days. So all across the board, but trade shows are one area where some states are very specific in the de minimis activities. So some of these activities up here, there may only be a handful of states that say that it's Nexus creating, but it varies widely from state to state. All right, so let's wrap up Nexus. As I mentioned, we have other webinars where if you want more of a deeper dive, we invite you to attend those. Physical Nexus is still alive. A lot of people out there think that all they have to worry about is economic Nexus, and that's just not the case. Economic Nexus is important, but you know, if a state finds you, your exposure goes back maybe 18 months. Some states only, you know, a handful of months. But physical nexus, you know, if a state finds you, they can go back to the date that your nexus actually began. In theory, you know, if that was 20 years ago, they could go back 20 years. In practice, states routinely go back 7, 8, or 10 years. I don't know of any states that go back 9 years. Economic nexus not going away. I speak to a lot of people and they say, well, Congress is going to step in and fix this. Well, you know, there's an economic nexus case out there for income tax, and Congress stepped in 1959. They passed a temporary law and they said, we've got to form studies and form committees and, you know, get a good answer on nexus because it's so confusing. So this is only a temporary solution. That was 1959. This is 61 years later. And we still have this temporary solution. And, you know, it's for some things out there, Congress has always been do nothing. So maybe our great-grandchildren may get the benefits of, you know, Congress doing something on economic nexus, but I don't see any short-term solutions. So this is something that your clients, you know, when the states passed this, they had no past exposure at all, but now things are starting to get old. And don't let this get away from you, or don't let this get away from your clients. Act sooner rather than later. Independent contractors, major risk factor for companies out there, subcontractors, you know, anyone who's helping you to establish or maintain a marketplace. And then real or tangible personal property owned or leased in other states. So we have a lot of companies who rent. When they first come to us, they don't realize that they have nexus everywhere they're, you know, have equipment or whatever they're renting located in another state. All right, so how do the states find you? Well, if you're selling on a business-to-business basis, auditing your customers is a big way. For everyone, auditing your vendors is a big way. You know, when a auditor comes out, they're not just looking at the sales to make sure that all the right tax is being collected and all of the tax is being remitted that is collected. They're also looking at purchases. So they're, you know, some states very formal. Let's back up there. Just because something is no tax on it when you buy it doesn't mean that it's tax-free. Maybe the vendor didn't have nexus in the state, didn't have to collect it. Maybe they didn't know they had to collect it. But if it's something that tax should have been on that transaction, then you need to self-assess and remit it as a consumer use tax, which we're going to talk about. That's one of our pillars. We're going to talk about that later on. But that's what the auditor's looking for. So that's the primary reason they're looking at your purchases, to make sure that tax was paid on it. And if it not, then it was self-assessed and remitted as a use tax. But they're also, that's a great prospecting tool. In Texas, they have an actual lead card that needs to be filled out for every new company that you see in an audit that didn't charge tax on its invoice. Now, that doesn't mean you're in trouble. You know, there may be a good reason why you didn't collect the tax. And, you know, you may or may got contacted right away. What it does mean is you're on a list, and being on a list is not a great thing. Information sharing with other states of the IRS. Remember, we just said that independent contractors who are usually paid with 1099s create nexus. So a lot of states will go to the IRS and say, please give me a list of everyone in our state who has received a 1099. Then they look at who's issued those 1099s, and then they compare it against who's registered for the tax. So information sharing with other states, especially in the Southeast, a lot of these states have sharing agreements. So one state finds you, you know, they're not going to share it with every state in the country, but they may share it with another 2 or 3 states. Leads, former employees. I mean, you get a disgruntled employee and they know that you should have been collecting tax. They may turn you in. And in some states, there are actually bounties. So not only do they get their pound of flesh, but they can get paid for doing it. Competitors, sometimes it's malicious, sometimes it's fairly innocent. You know, I use the story all the time. There was this camera leasing company in the state of Massachusetts, found them and said, hey, you've got Nexus in our state. How long have you been selling into our state? The company said, well, we've been doing it forever. And the state of Massachusetts said, well, we want the last 8 years worth of taxes plus penalty and interest. And this camera leasing company said, oh, no, we're not doing anything wrong. We're doing this correctly. We don't need to collect tax. Everybody in our industry does it this way. State of Massachusetts said, well, give me everybody's contact information and we'll make sure that they're all doing it correctly. So the way we found out about this is we got a call from one of their competitors. He said, hey, one of our competitors turned this in. Is this a real thing? Do we have exposure? And unfortunately they did. We helped them fight the audit in Massachusetts, and then we helped them get right in all of the other states. But sometimes your competitors turn you in. Sometimes your customers turn you in. I mean, if you're not charging tax, they may call the state and say, hey, state, my vendor didn't charge me tax. Do I need to pay use tax on this? Next thing you know, the state is saying, who's your vendor? Sometimes your vendors can get audited, or they can turn you in if you get sideways with them. And then some states like Utah, they're actually purchasing lead lists at this point. The state of Utah purchased a lead list of everyone they think is over their economic nexus, which took effect on January 1st of 2019. It's $100,000 or 200 transactions. And Utah's calling everybody. And by the way, although they are looking for economic nexus, they're stumbling across all types of other nexus. And I think this is something we're going to see a lot more of as all of these states are beefing up their discovery units. And a discovery unit is the unit inside the state that looks for taxpayers that are not currently registered that they think should be registered. They're the ones who are, you know, going out to the IRS and getting information. They're the ones that are following up on all of these leads generated by auditors. And they're also doing a lot of web surfing. They go out there and look at websites, or they have, you know, software programs that do it for them, looking for certain terms that make it look like someone's doing business in their state. So lots of different ways for states to find you. If you're already registered, any type of red flag is an issue, like large exemptions on your returns, inconsistent data on your returns, numbers don't balance, consistent mistakes. These are all things that can red flag your account for an audit. Also, if a state, you know, like Massachusetts, finds that an industry is doing something wrong, they will target that industry, and whether you're registered or not, they're going to start choosing you for audit. So lots and lots of ways that states can find out you. By the way, IT companies in Texas are frequently the target of audits because everything's so confusing in Texas when it comes to those issues. All right, Ellie, next poll question.
Absolutely, that should be up on your screen right now. We want to know what it is about Sales Tax Nexus that concerns you the most. So we'll leave this open 15, 20 more seconds. A quick reminder, you do have to answer these poll questions in order to receive CPE credit. Like a lot of people are answering that economic nexus is the thing that is concerning the most, but we have questions all over the board here. If you are having trouble seeing the poll questions, just shoot me a message in the Q&A with the answer to what answer you would choose, so we can take note of that and make sure we get you your credit. So we'll close this out, Mike, and move on.
Okay, so we're going to talk about taxability now. This is our second pillar. And by the way, knowing all of these 7 pillars can't prevent an audit. You know, what they can do is, if you understand these 7 pillars, then they'll greatly reduce the possibility of a large assessment. Sometimes an auditor's out there, he may find something or may not find something, but if you have these 7 pillars down, you're going to limit either for yourself or for your clients the possibility of an assessment. So I love, how granular some states get. So in New York, that first picture is an unsliced bagel. You buy one unsliced bagel in New York, not taxable. As soon as it gets sliced, it becomes taxable. You don't even have to have any schmear on it or anything else. Yeah, nothing on that bagel. Just the fact of slicing it now makes it taxable. So, I love this story because it really, to me, illustrates how granular that states can get. We're going to talk about 10,000 foot overview here when we're talking about taxability because things can get so granular. Tangible personal property, which is something that can be seen, touched, felt, smelled, tasted. It's something that sits on an inventory shelf, something that can be perceived by the senses and is not real property or intangible property. We call that tangible personal property in TPP or TPP. And TPP, a lot of people think of it, tangible personal property. Well, that must be like a calculator or a smartphone or a woman's handbag. No, it's anything that meets that definition. It could be an airplane, could be a tractor. All of this is considered tangible personal property, and tangible personal property is by default taxable unless there's an exemption, and there are plenty of exemptions. The exemption may be by item, so in a lot of states, groceries are exempt. In some states, they're not. So that would be an item. It may be by use, manufacturing exemptions, resale exemptions. Those are by use, and then by entity, nonprofits, the federal government, these would be example of by entities. So three major types of exemptions out there. Now, TPP is often stretched by statute. So I wouldn't think of electrically downloaded software as tangible personal property. However, some states in their statutes, they defined TPP to include electronically delivered software. Electricity. I mean, I guess you could feel it if you stuck a fork in the socket, but other than that, I wouldn't think of electricity being tangible personal property. But again, in a lot of states, they stretch the definition of tangible personal property by statute. So something we have to look out for there. Tangible personal property incorporated into real property is generally not taxable. Because it becomes a part of the real property. That's the theory behind this. And real property is generally not taxable. We're going to hear terms like permanently affixed, if it loses its identity, damage to property if removed. Here's the problems. Every state is going to define all of this stuff differently, but a lot of things, if you're selling to contractors, the contractors, don't sell it for resale. They're actually the consumers of this. And they've got to pay tax on their purchases because they're not turning around and collecting tax on the sale. So TPP incorporated into real property, generally not taxable. All right, so tangible personal property used in or consumed in manufacturing, generally not going to be taxable. Now, manufacturing process has a start and a finish, and each state defines the process differently. Some states like Texas say that interplant transport is not part of the manufacturing process. So, you may buy a forklift in one state and, it's used in the manufacturing process and it's exempt. And in a state like Texas, it's used to move things between the phases of manufacturing, and it's fully taxable. So, I had a client who they actually purchased 2 cranes, and one of the cranes was, moving things throughout the manufacturing process. The other crane was located maybe 30 feet away, and they used it to move things. Once they came off the manufacturing process, they'd roll them out to the loading dock. And 30 feet away, same exact crane, and they used that crane to load things onto the trucks. One crane was exempt, one crane was fully taxable. The company had purchased them both on a tax-free basis, thinking that they were both part of the manufacturing process. So you gotta be cognizant of where the manufacturing process starts and where it finishes, what's included, what's not included. Common phrase, predominant usage. Some states will say if it's partly used for this, if it's partly used for that, what's the predominant usage? What's it mostly used for? So tangible personal property used or consumed in manufacturing, generally not taxable. All right, services. Unlike tangible personal property, which are going to be taxable by default, services are generally not taxable by default. They generally have to be specifically enumerated or listed in order to be taxable. And sometimes a non-taxable service, all right, can become taxable when sold in conjunction with tangible personal property. And even a non-taxable service can become taxable when sold in conjunction with a taxable service. So, you know, if you're doing lump sum billing out there, or if you're doing mixed transactions, you know, bundling everything together, you can actually be turning, you know, a lot of non-taxable stuff into taxable stuff, because some states say if you're mixing them, the whole thing becomes taxable. Here's a big one too. Whenever I start talking about services, someone always says, well, services are not taxable in my state. So all states tax at least some services. Very controversial statement. I know people are going to challenge me on it. You're welcome to, and you know, I'll come back and I'll let you know what services your state taxes. So a lot of times it has to do with fabrication or sometimes shipping or whatever else, but all states tax at least some services. Here are some states that tax pretty much all services: Hawaii, New Mexico, South Dakota, and West Virginia. As a matter of fact, Hawaii and South Dakota even tax accounting and legal fees. So if you're do business across the country and you've now got an economic nexus in South Dakota, which means that, and you're an accountant and you have 200 invoices that go into the state of South Dakota, you should be collecting sales tax on your invoices. So Hawaii, same way. They have a 200 transaction economic nexus. So 200 invoices into Hawaii, you're an accountant and doing business remotely. Now you got to collect tax on your on your accounting invoices. New Mexico and West Virginia don't tax accounting and legal fees, but they do tax most other services. In these 4 states, service has to be specifically exempted. So they're not like the other states where a service has to be listed in order to be taxable. It's the other way around. Service has to not be specific exemption, not to be taxable. All right. This varies widely by state, but here are some commonly taxed services. You know, one that catches a lot of companies are these real property services, you know, janitorial type services. This catches a lot of companies off guard. So does the fabricating, the printing and imprinting. So lots of services are taxed, you know, and as I said earlier, every state taxes at least some services. And, you know, sometimes services are viewed through the prism of how a state taxes everything else. For example, you know, if you're helping your client out, your client comes to you and says, hey, we're offering website design and website hosting in the state of Texas. And you look at the list of enumerated services in Texas and you don't see website design or website hosting listed anywhere. So you may go back to your client and say, hey, they don't tax website design or hosting in Texas. It's not an enumerated service, so you're good to go. And that's why there are so many problems here in Texas, you know, for you know, IT companies and related type services, because of, you know, sometimes we just look at the surface. We don't do the deep digging because, and this doesn't make sense to me. When I think of website design and website hosting, I don't think of data processing, but the state of Texas has long held that both of these services actually fall under the umbrella of data processing. So sometimes you got to go deeper than the statute. You know, when you're doing your research, it's not always in the statutes. You got to go into the rules, the regulations. You got to look at the guidance. You got to look at the different rulings in court cases as to how a state actually looks at these things. Another example would be South Carolina. I would never think of software as a service as a communication service, but they were taxing, you know, software as a service as a communication service for quite a while. So digital property, you know, how this gets taxed varies widely by state, and it's constantly changing. Some states define digital property, some do not. Software is generally not going to be considered digital property. Software is often, not always, but it's often included with the tangible personal property. Some of the states that are now passing digital property taxes are including software, but in general, it's included under tangible personal property. South Dakota, Washington, D.C., 2 states began collecting tax on digital products this year. All right, Ellie, let's go to the next polling question.
Absolutely, that should be up on your screen right now. Remember, if you can't see the poll questions, please answer them. The question that we have is, which of the following statements is true? So services are not taxable in most states. Services are taxable by default in most states. So all states tax at least some services, or digital property is now taxable everywhere. So we'll leave this open 5 or 10 more questions while these answers keep rolling in, and close it and move on. And Mike, just so you know, most people are saying all states tax at least some services.
Great. Good group here. That is the correct answer.
Perfect.
All right, so let's move on to rates. And each one of these boxes or colors, number one, I'm colorblind. So I'm seeing this map a lot differently than you are. And I've never bothered to count all of these boxes on there, but I've heard estimates anywhere between 7,500 and 1,500. The number that we use is 13,000. So that's how many different taxing jurisdictions are out there, or approximately how many different taxing jurisdictions are out there. If you're doing a lot of transactions, then this is something that lends itself very well to automation. So we'll go over a couple of things that you can look at. But for now, I want to talk about origin versus destination. There are some of the lesser software companies out there that overemphasize origin to the point where we get people calling in and say, well, I don't have to collect tax in a destination state because it's shipping from an origin state. So I collect the tax in the origin state, or I don't have Nexus in the origin state, or whatever they say. That's not it at all. Origin is only about which local taxes should be collected, and it only applies when a transaction is 100% within the state, and not even all states look at origin. So there's way too much of an emphasis on origin versus destination. We have to set so many clients straight when they come to us after hearing this malarkey that other people have put into their head. Here's what we want to be looking at. All right, which state's rate do we use? Now, for interstate sales of tangible personal property, the delivery state is going to generally determine the state rate to use. So wherever this is getting delivered, that's generally going to be the state's rate that we use. Now, for interstate sales, we use origin or destination, one or the other, but we're still, you know, it's based on destination for the state part. It's only the local part that's going to be affected for that. What about services or digital property? Generally, where the benefit is received is going to be what we use for services on a sales tax basis. And for digital property, there's a hierarchy of knowledge known at the time of sale. So if here's the hierarchy, this is actually from North Carolina, and they go through this. Most people default to the billing address or the shipping address. That's something that you're generally collecting at the point of sale, but there is a hierarchy. So this is something that you can go through. If you have any questions, just let me know. So how do you figure out rates? Well, you can call the state or check the state website. That's one way to do it if you've got very low volume. I mean, some of our clients, sell big ticket items, and, they only do this once a day. So that's not too bad a process. Or you can use a free rate lookup. There's lots of them out there. If you need one, let us know and we'll get it to you. There are rate tables. Sometimes you've got a, legacy shopping cart or invoicing system, and you can't connect to one of these automation companies out there. So you may need a rate table. And we can provide those if you need them. But this is a service or this is a pillar that lends very well to automation. They're the companies that we like the best out there, or would be a Vertex or an Avalara. These companies have been around for forever. They're very good. The other companies, the smaller you are, the better choice they are, but the bigger you are, you want to go with quality. All right. So, Ellie, last polling question.
Absolutely. That should be up on your screen right now. We have a quick true or false question. TPP is generally sourced to the ship to state. True or false? We'll leave this open 10 more seconds here while answers are still rolling in. Mike, right now it looks like everyone is answering true. I don't know if you want to go over this quickly.
That is the true answer.
Perfect.
True is the true answer. How about that?
So, yes, true is the true answer. We'll close this out and move on.
Okay. Let's move on to use tax. And, historically speaking, it was widely believed that interstate commerce could not be taxed directly. Even the states, when sales taxes first started, the modern day sales taxes first started coming out in the 1930s, even the states didn't believe that you could tax interstate commerce directly. So they came up with a complementary tax. And the tax was for the storage, use, or consumption of a product or service in a state. Back then, it was mostly products. It's been expanded to service now. So this prevented companies from setting up on the border of say, Texas. Maybe they were in Louisiana or Oklahoma. Maybe they were 100 feet away from the other store, but one collected this tax and one didn't. So states did this to protect their in-state companies. Now, if sellers had Nexus, they still had to collect the tax. So for most people, you're paying a tax. You don't know if you're paying a use tax or a sales tax. But when you're registering and when you're doing the returns, sometimes it does make a difference. By the way, there's only one use tax. It's just when we talk about a vendor's use tax or a seller's use tax versus a consumer's use tax, it's still the same use tax. It's just who has a responsibility to pay it. All right, so technically speaking, only sales that never cross a state line are subject to a sales tax. As a matter of fact, unless you have bricks and mortar in a state, when you're doing the registration process, you're usually going to be registering for a use tax. If you have bricks and mortar, a physical building in a state, then you're generally going to be getting registered for a sales tax. Now, since 1977, when we had complete auto transit and the U.S. Supreme Court said, yes, states can tax interstate commerce directly, the lines have started to be blurred. And some states don't make a distinction at all anymore, except for a consumer use tax. But a lot of states, when you're registering, it makes a difference. Take Oklahoma, for example. In Oklahoma, if you're registering for the use tax, which means you don't have a physical presence there, there's no cost to get the use tax permit. You don't have to worry about getting registered with the Secretary of State. You don't have to worry about income tax or any of that. But if you're registering for a sales tax, number one, there's a $20 fee for that. Then you got to get a registered agent. You got to get registered with the Secretary of State. You're subject to income tax. So there's a big difference in which tax you get registered for. And again, some of these cheaper software companies like a TaxJar is telling you, oh, well, we can't do the use tax return. So just go back and get registered for the sales tax. It doesn't make a difference. It does make a difference. It makes a huge difference, and shame on these companies for saying otherwise. So consumer use tax, you know, we mentioned earlier that when an auditor comes out, they want to make sure that not only are you collecting the right tax and remitting all of it, but they're making sure that you're paying tax on your purchases. I mean, just because the seller doesn't charge a tax does not mean it's tax-free. You're supposed to be self-assessing, remitting it to the state yourself. By the way, this goes for individuals as well as businesses. The problem is that individuals are not audited, but businesses are. And this is, you know, either number one or number two reason for large assessments in an audit. The other one is exemption certificates, which we'll cover tomorrow, but consumer use tax. I mean, companies get this wrong all the time, so much to the point that big companies like John Deere, they came out, you know, a couple of years back and they said, we're tired of getting dinged in audits for this consumer use tax. We'll only deal with vendors who charge us sales tax on a going forward basis. So consumer use tax, huge, huge issue. And you just want to make sure that you've got someone looking at invoices and seeing where you need to accrue and remit to the state and where you don't. So for consumer use tax, you've got to have a system in place, and the system may be reviewing all invoices. If you don't have a lot of invoices, a lot of companies do it that way. If you have tons of purchase invoices, then maybe you look at every invoice over a certain dollar amount. And then on the smaller invoices, then you just do it on a sample basis. Sometimes, you know, there are certain vendors out there who get it wrong all of the time. Maybe you identify certain vendors and say, we're going to review every one of these vendors. So this is something that does not lend itself very well to automation. We said that rates do. I forgot to mention that taxability doesn't lend itself very well when you're trying to figure out upfront what's taxable. But once you figure out what's taxable, automation does a great job of keeping you in compliance. Consumer use tax, there's a lot of systems out there, but it's best to generally use a blended approach. Don't do it totally manually. Don't do it totally automated, but do a blended approach. And by the way, there's no perfect solution here, and perfection is not a realistic goal. You want to try to catch the most errors out there. You don't want to try to, you know, catch every single tiny little error out there. And by the way, this is not just, when you put a system in place, you're not just looking for underpayments, but you're looking for overpayments, because a lot of times, you know, your vendors, they're scratching their head and say, is this taxable or not? And they come up with the solution. It's a gray area. We're going to be conservative. We're going to collect the tax. A lot of people do that. So it may not be taxable, and you may know it's not taxable, or you may have an exemption that they don't know about. So this process is also great for tax refunds. So at this point, Ellie, I'd like to open it up to questions. And by the way, this webinar series here is just to get you familiar with the 7 pillars out there and what the 7 pillars are. And all our years of experience, every issue in an audit can be tied back to one of these 7 pillars. So that's why we want to make you aware of them. And it's a 10,000-foot overview. We'll go into much deeper details if people want that on future webinars. Ellie, what type of questions we have?
Yeah, absolutely. So let's do this question here, Mike. So they say, we are distributed located in Texas. If we install TPP for a manufacturer in Florida, this would be taxable. Do we need to register for Florida sales tax?
Everything is fact specific, but based upon the facts that you're sharing with me, I would say yes, that there's a good probability that this is going to be Nexus creating in Texas, and therefore create a tax collection responsibility. Not 100%, but it is an activity that most states look at as creating Nexus.
All right. Thank you so much, Mike. And did you want to touch base on anything else? Anything else today?
I think we did a good job and we covered it all. We've got a couple of minutes here. I'll share one story. This is about use tax, and we were called in on an audit. This is a number of years ago now, and there was a woman. She was a manufacturer, and she was in accounts payable, and she was crossing off the tax on all the different invoices. She thought she was doing such a great job and saving all of this money for the company, because in her belief, you know, manufacturers don't pay tax on their purchases. Well, all of a sudden, you know, they get audited and there's a line item in the audit for toilet paper. And it's like hundreds of thousands of dollars because they were buying for the entire country. And, you know, the auditor's talking to us and he says, tongue in cheek, well, you know, hey, I know that toilet paper is used and consumed, but it's not used and consumed in the manufacturing process. So he set it up in the audit. Now, can you imagine if you're this poor woman and you got to go to your bosses and tell them, yeah, we got to pay, you know, tens of thousands of dollars on toilet paper that we didn't pay the tax on. Just not a great situation. So use tax, very, very important. And on that, I'll let it go, Ellie.
All right. Thank you, everyone, for coming and joining us today. I really encourage you to join us tomorrow to finish out the 7 Pillar series, and also to join us for future webinars as well, along with checking out some of the really great resources that we have on our website. We have a lot of free resources and we have paid ones as well. We have a whole premium portion of our website designed for accounting professionals. We've had a lot of great feedback on that. And Mike, did you want to say anything else before we wrap it up here?
Just be brutally honest on the feedback. That is how we get better. And if there are any other webinars that you would like information about, let us know. We take recommendations all the time. And if we can, we'll put something together and get it on out there.
Absolutely. Thank you so much, everyone. And once you fill out that survey, if you're looking for CPE credit, you can expect to receive that within the next 48 hours. If the pop-up doesn't work for you, I know some people were having some problems today, it will be emailed to you in 24 hours. So you'll have a couple ways to get your hands on that survey. And everyone have a great afternoon.
Thank you, everyone. Bye-bye.